The financial world has witnessed countless scandals over the last several decades, yet few institutions have remained as consistently connected to allegations of commodity market manipulation as JPMorgan Chase & Co. Now, according to reports circulating among institutional trading desks, independent analysts, and metals market observers, a newly leaked document allegedly reveals a staggering $2.1 billion silver position tied to the banking giant, an exposure so large that it has reignited long-standing suspicions about concentrated control inside the global precious metals market. What makes this revelation especially explosive is not merely the size of the position itself, but the timing surrounding the disclosure. Global central banks are rapidly accumulating hard assets. Industrial demand for silver has surged due to artificial intelligence infrastructure and solar manufacturing, and physical silver inventories across major exchanges continue showing signs of stress. Against this backdrop, the emergence of an enormous paper silver position raises one unavoidable question. Is the silver market once again being artificially suppressed by institutional forces operating behind closed doors? Veteran commodity analysts argue that the current situation resembles the early stages of previous market dislocations, where leverage became unsustainable and hidden exposures suddenly surfaced into public view. Several former metals traders have suggested that such a massive concentrated position would be nearly impossible for ordinary market participants to establish without attracting immediate regulatory scrutiny, yet systemically important financial institutions often operate under vastly different conditions. The alleged leak has therefore intensified debate over whether major bullion banks possess structural advantages, allowing them to influence price discovery through derivatives rather than genuine physical supply and demand. For years, critics of the silver market structure have argued that futures contracts, traded on paper exchanges, dramatically exceed the amount of deliverable physical metal actually available in vaults, creating an artificial mechanism capable of controlling price volatility while maintaining investor confidence in fiat currencies and sovereign debt systems. What has made this latest controversy particularly significant is the growing body of historical evidence surrounding prior enforcement actions connected to precious metals trading activities. In 2020, the United States Department of Justice and federal regulators announced one of the largest spoofing and racketeering settlements ever imposed on a major financial institution, after traders associated with JPMorgan's precious metals desk admitted to manipulating gold and silver futures markets over an extended period. The settlement involved hundreds of millions of dollars in penalties and confirmed what many independent analysts had claimed for years, that certain trading strategies were deliberately used to create misleading market signals capable of influencing short-term price direction. While the bank neither collapsed nor lost its dominant market position afterward, the scandal fundamentally altered public perception regarding the integrity of commodity exchanges. Now, with reports of a $2.1 billion silver position allegedly surfacing at a moment of intensifying global financial instability, many observers believe the implications could extend far beyond another regulatory embarrassment. Some analysts argue that the sheer scale of concentrated short exposure in silver may represent a systemic vulnerability embedded within the broader banking framework itself. If physical silver demand accelerates, while large paper positions require settlement or rollover under increasingly constrained supply conditions, liquidity stress could emerge rapidly. This scenario becomes even more dangerous when combined with rising geopolitical tensions, weakening confidence in sovereign debt markets, and mounting expectations of future monetary easing by central banks attempting to stabilize slowing economies. Institutional investors have begun quietly increasing exposure to hard assets precisely because they recognize the fragility developing beneath the surface of the global financial system. The silver market occupies a uniquely strategic position within the modern economy because silver is simultaneously both a monetary metal and an industrial necessity. Unlike gold, which is primarily accumulated for wealth preservation and central bank reserves, silver is consumed extensively in electronics, solar panels, medical technologies, military systems, and high-performance industrial manufacturing. This dual demand structure creates extraordinary sensitivity during periods of supply imbalance. Over the past several years, mining production growth has failed to keep pace with accelerating industrial consumption, particularly as governments worldwide push aggressively toward electrification and renewable energy expansion. Analysts at major commodity research firms have repeatedly warned about structural deficits developing within the silver market, where annual physical demand increasingly exceeds newly mined supply. Under normal market conditions, such persistent deficits would likely trigger substantially higher prices over time. Yet, despite these tightening fundamentals, silver has often remained surprisingly subdued relative to inflation, currency debasement, and industrial demand growth. This disconnect has fueled accusations that large institutional trading entities may be suppressing price discovery through highly leveraged derivatives activity on futures exchanges. Critics point specifically toward concentrated short positions capable of overwhelming natural buying pressure during key trading sessions, thereby influencing investor psychology and discouraging momentum participation from retail traders. The alleged $2.1 billion position leak has therefore become symbolic of a much larger concern surrounding transparency, leverage, and the true state of physical metal availability inside the global financial system. As speculation surrounding the leaked exposure intensified, attention quickly shifted toward the potential consequences if silver prices begin rising aggressively against large institutional positions. Commodity history demonstrates that concentrated short trades can become catastrophic when physical demand overwhelms paper market assumptions. During previous market squeezes involving industrial commodities, institutions relying on leveraged derivatives often discovered that liquidity disappears rapidly once confidence erodes. Some veteran traders now fear that the silver market may be approaching a similar inflection point. Exchange inventories have shown periodic declines, retail bullion demand remains resilient despite economic uncertainty, and sovereign governments continue diversifying away from traditional reserve structures dominated by the United States dollar. Meanwhile, inflation pressures persist across multiple sectors of the global economy, even as growth slows, creating the dangerous combination commonly associated with stagflationary environments. Historically, precious metals tend to perform exceptionally well during such periods because investors seek tangible stores of value insulated from monetary expansion and declining purchasing power. If silver were to experience a sustained breakout driven by physical shortages or institutional repositioning, the implications for heavily leveraged participants could become severe. The alleged leak has therefore amplified fears that certain major financial entities may be trapped within a market structure, increasingly vulnerable to a disorderly repricing event. Whether the reported $2.1 billion position ultimately proves entirely accurate or partially exaggerated, the controversy itself has already reignited global scrutiny over one of the most opaque and controversial sectors of modern finance: the intersection between bullion banking, derivatives leverage, and precious metals price discovery. To understand why the alleged $2.1 billion silver position has generated such intense concern among market observers, it becomes necessary to examine the mechanisms through which modern commodity markets actually operate. Contrary to popular belief, most silver trading does not involve the exchange of physical metal. Instead, the overwhelming majority of transactions occur through derivatives contracts, primarily futures, options, swaps, and synthetic instruments traded electronically across major financial exchanges. These contracts represent claims on silver rather than direct ownership of bullion itself. This distinction is critically important because it allows financial institutions to create exposure vastly exceeding the amount of physical silver available in global vault systems. In practical terms, the paper silver market has grown to a size many times larger than annual worldwide mine production, enabling large institutional participants to influence short-term pricing dynamics without needing equivalent physical inventory. Critics of the current system argue that this leverage distorts genuine price discovery by allowing paper supply to suppress natural reactions to tightening physical demand. Over time, bullion banks developed sophisticated trading infrastructures, capable of executing massive algorithmic orders within milliseconds, often during periods of thin liquidity when price movements can be exaggerated most effectively. Independent researchers analyzing historical trading data have repeatedly identified unusual patterns in precious metals, futures markets, including abrupt sell-offs involving enormous contract volumes appearing at moments seemingly inconsistent with profit-maximizing behavior. Such activity fueled long-standing suspicions that certain institutions were prioritizing strategic price influence rather than ordinary speculative trading. The controversy surrounding JPMorgan became especially significant because the institution has occupied a uniquely dominant role within global precious metals clearing and derivatives markets for decades. Following the collapse and acquisition of Bear Stearns during the 2008 financial crisis, JPMorgan inherited extensive commodity trading operations that dramatically expanded its influence over silver and gold markets. Analysts tracking exchange disclosures observed periods where a remarkably concentrated percentage of total silver futures positions appeared connected to only a handful of major banks. While defenders of the system argued these positions merely reflected hedging activities for client business and market-making functions, critics countered that the concentration itself represented a dangerous structural imbalance capable of undermining competitive price formation. Regulatory investigations eventually validated at least part of these concerns. The Department of Justice described extensive spoofing operations where traders placed large deceptive orders intended to manipulate market perception before rapidly canceling them. Such tactics created artificial impressions of buying or selling pressure designed to influence algorithmic systems and other traders reacting to visible order flow. Although spoofing represented only one dimension of broader manipulation allegations, the scandal demonstrated that major institutions possessed both the capability and willingness to distort precious metals. Markets, when incentives aligned. Therefore, when rumors emerged regarding another enormous silver exposure linked to JPMorgan, skepticism spread rapidly because historical precedent already existed. The broader geopolitical and macroeconomic environment has further intensified the significance of these allegations. Over the last several years, global trust in traditional monetary systems has weakened considerably. Central banks worldwide accumulated gold reserves at the fastest pace in decades, while simultaneously reducing dependence on dollar-based financial infrastructure. Nations, increasingly concerned about sanctions risk, sovereign debt instability, and currency debasement, have sought alternatives capable of preserving long-term purchasing power outside conventional banking channels. Silver, while often overshadowed by gold in mainstream financial media, occupies an especially strategic position because of its critical industrial applications. The global transition toward renewable energy technologies has created unprecedented demand growth for photovoltaic solar panels, advanced semiconductors, electric vehicles, and high-efficiency electronics, all sectors heavily reliant on silver due to its superior conductive properties. Industrial demand therefore continues rising even as mining production struggles with declining ore grades, permitting challenges and geopolitical disruptions affecting major producing regions. Commodity analysts now describe silver as one of the few assets simultaneously benefiting from monetary uncertainty and technological expansion. This dual dynamic increases the risk that any major disruption within paper trading structures could trigger an accelerated repricing event if physical availability becomes constrained. Many institutional investors have quietly acknowledged this possibility through changing portfolio behavior. Hedge funds, sovereign wealth funds, and private family offices increasingly seek direct physical metal exposure rather than relying exclusively on exchange-traded financial instruments. This shift reflects growing concern that derivative markets may not function smoothly during periods of severe systemic stress. Historically, financial crises expose hidden leverage accumulated during years of relative stability, and precious metals markets are particularly vulnerable because of the enormous ratio between paper claims and actual deliverable inventory. If enough participants suddenly demand physical settlement simultaneously, exchanges and bullion banks could face unprecedented strain. This scenario remains theoretical for now, yet the alleged $2.1 billion silver position leak has intensified fears that concentrated exposures may already exceed manageable levels. Some analysts compare the situation to previous commodity squeezes, where institutions underestimated the speed at which liquidity conditions could deteriorate once market psychology shifted. During such events, short covering accelerates rapidly, volatility expands dramatically, and pricing disconnects emerge between paper contracts and physical assets. Silver's relatively small market size compared to global bond or equity markets means that even modest capital inflows can produce outsized price movements under stressed conditions. Perhaps the most important issue raised by the current controversy involves confidence itself. Financial systems ultimately depend on trust that contracts will settle, trust that markets remain fair, and trust that regulators enforce transparency consistently across all participants. When repeated scandals emerge involving major institutions manipulating benchmark markets, public confidence deteriorates gradually but persistently. The perception that powerful entities operate under different rules than ordinary investors creates skepticism not only toward specific banks, but toward the integrity of the broader financial architecture. This erosion of trust becomes especially dangerous during periods of economic uncertainty, because investors begin seeking alternatives outside conventional systems. Precious metals historically perform well under such conditions precisely because they exist independently of counterparty promises. A physical silver coin does not require faith in derivatives, clearinghouses, central bank policy, or institutional solvency. Consequently, every new controversy surrounding a paper market manipulation inadvertently strengthens the long-term investment case for tangible hard assets. Whether the alleged JPMorgan exposure ultimately results in regulatory action, market disruption, or merely another cycle of public outrage followed by institutional continuity, the underlying tensions driving concern within the silver market remain unresolved. Structural deficits, rising industrial demand, geopolitical fragmentation, and expanding monetary uncertainty continue converging beneath the surface of a financial system increasingly dependent on leverage and confidence maintenance. As debate surrounding the alleged $2.1 billion silver position intensifies, a growing number of macroeconomic strategists now believe the market may be approaching conditions capable of triggering a historic repricing event unlike anything witnessed in modern commodity history. Such predictions would have sounded extreme only a few years ago, Yet the convergence of current global trends has fundamentally altered the risk landscape surrounding precious metals. Inflation remains structurally elevated across many advanced economies, despite aggressive central bank tightening campaigns. Sovereign debt burdens continue reaching unprecedented levels, while economic growth slows beneath the pressure of higher borrowing costs. Governments increasingly rely on deficit spending to stabilize weakening consumer demand and maintain political stability, creating long-term concerns regarding currency purchasing power. Historically, these environments have favored tangible monetary assets, particularly when confidence in traditional fiscal and monetary management begins deteriorating. Silver occupies a uniquely explosive position within this framework because its market capitalization remains relatively small compared to the scale of global institutional capital capable of moving into hard assets during periods of instability. Even a modest reallocation from bonds or equities into physical silver could produce extraordinary price volatility due to constrained supply conditions and the limited size of available inventories. One of the most important developments reshaping the silver market involves the widening divergence between physical demand and paper pricing mechanisms. In recent years, retail bullion shortages periodically emerged across multiple countries, even while futures prices remained comparatively subdued. Dealers frequently reported delayed deliveries, rising premiums, and strong purchasing activity during episodes of economic uncertainty. Simultaneously, industrial consumers accelerated procurement strategies to secure long-term supply amid fears of future shortages linked to renewable energy expansion and semiconductor manufacturing growth. Analysts estimate that solar energy demand alone could consume increasingly significant percentages of annual global silver production over the coming decade. Unlike gold, much industrial silver is not economically recoverable after use because it becomes embedded within manufactured products at tiny concentrations. This means substantial amounts effectively disappear from the accessible supply chain permanently. Such structural realities have led some commodity researchers to argue that silver may be one of the most undervalued strategic resources in the world economy. If true, the implications for heavily leveraged short positions become profound. Markets can tolerate large synthetic exposure structures during stable periods, but once physical scarcity begins challenging confidence in settlement assumptions, repricing can occur with stunning speed. The role of central banks and institutional monetary policy also remains central to the unfolding silver narrative. Following years of aggressive rate hikes designed to combat inflation, financial markets increasingly anticipate eventual policy reversals as economic momentum weakens globally. Historically, precious metals perform strongly during transitions from restrictive monetary conditions toward easing cycles, because declining real interest rates reduce the opportunity cost of holding non-yielding assets. Additionally, renewed liquidity injections often reignite inflation expectations and weaken confidence in fiat currency stability. Several veteran analysts now argue that central banks face an impossible dilemma: maintain tight policy long enough to fully suppress inflation and risk severe recessionary instability, or pivot toward monetary accommodation and accelerate currency debasement pressures. In either scenario, investor appetite for tangible stores of value could expand substantially. Silver's historical tendency toward violent upside volatility during precious metals, bull markets further amplifies interest among speculative traders seeking asymmetric opportunities. During previous major cycles, silver significantly outperformed gold on a percentage basis once momentum accelerated and institutional participation intensified. This historical precedent has encouraged growing speculation that any sustained breakout above key resistance levels could unleash a rapid cascade of short covering and momentum-driven capital inflows. Another critical factor involves the changing psychology of younger investors and independent market participants. Over the last decade, distrust toward large financial institutions has expanded dramatically following repeated crises, bailouts, and manipulation scandals across multiple asset classes. Social media platforms and decentralized information networks now allow independent researchers, retail traders, and alternative analysts to disseminate market theories rapidly outside traditional financial media channels. The GameStop phenomenon demonstrated that coordinated retail participation can create extraordinary volatility when institutional positioning becomes vulnerable. Some silver advocates believe similar dynamics could eventually emerge within precious metals markets, particularly if evidence of concentrated short exposure gains wider public attention. Although silver's market structure differs substantially from equities, the underlying principle remains similar. Excessive leverage combined with crowded positioning can produce destabilizing squeezes once market psychology shifts. The alleged JPMorgan leak has therefore become more than a simple controversy regarding one bank's trading activities. It symbolizes broader fears about opacity, leverage, and systemic fragility embedded throughout modern financial markets. Every new revelation strengthens the perception that paper-based systems may be increasingly disconnected from underlying economic realities. Ultimately, the future direction of silver will depend on whether confidence in existing financial structures remains intact or begins deteriorating under the pressure of rising debt, inflation persistence, geopolitical fragmentation, and declining trust in institutional credibility. If stability returns and global growth normalizes, silver may continue trading within historically volatile but manageable ranges. However, if physical demand intensifies while large leveraged exposures encounter mounting pressure, the consequences could become transformative. A disorderly repricing event would not merely impact commodity traders, it could expose deeper vulnerabilities inside derivative markets, clearing systems, and institutional balance sheets interconnected throughout global finance. This is precisely why the alleged $2.1 billion silver position has attracted such widespread attention among analysts, investors, and economic observers worldwide. Regardless of whether every detail surrounding the leak ultimately proves accurate, the controversy has illuminated tensions that have existed beneath the surface for years. The silver market now stands at the intersection of industrial necessity, monetary uncertainty, and institutional leverage. History demonstrates that when such forces converge simultaneously, markets rarely remain stable indefinitely.